This is another question I get asked. What about emerging markets? Let's look outside of tech. Okay, let's look at emerging markets. Let's take an example. China, India, Brazil, and Vietnam. Let's have a look at some of those. Amazon pledges massive 35 billion into India. So Amazon is my emerging or developing market play, because the alternative is you either go into an index tracker for India, which I'm going to show you in a second, okay, and what the problem with that is. Let's have a look at it. So take emerging markets. So this is the same applies to Brazil, Vietnam, or whatever. Okay, so let's take India. Okay, now the problem I have with that, and I don't have a problem with India, and take China or Brazil, okay, is this: when you project forward the rate of growth, and I've taken a little bit lower than it's done a couple of historic times, you're only getting 14% in a year, which is well below the kind of returns I want. And you might say, yeah, but Alpesh, you're only getting a lower return because you've got less volatility. Really? Because that's down 18%. Hello, that's the S&P 500. And that's down 25%. Okay. So for me, the countrywide one is too large. Okay. In that case, what about companies then? Well, the only companies I wouldn't want the ones listed in India, because I'd have to have rupees, or in China. So what I'd end up with is I'd say, well, which is a good prospect compared to, in the case of China, a China index? Well, I'd rather go into an Alibaba, which incidentally I don't want, not because there's anything wrong with it. I don't have any doubt that it'll continue going higher. It's that I don't like the volatility. The ride